Welcome to Barron's Roundtable, where we get behind the headlines to prepare you for the week ahead. I'm Jack Otter. Coming up, markets swinging as the conflict with Iran drives volatility across multiple sectors. We'll break down where investors should put their money and strategies that can help you manage the geopolitical crisis. We begin with our expert panel and three things investors ought to be thinking about right now. On the Barron's Roundtable, my colleagues Ben Levisohn, Elizabeth O'Brien, and Jack Hough. Wow, Ben, what a week, huh? So we don't normally panic here at Barron's. We know markets sometimes go down. That's what they do. But you seem a little more concerned than usual this Friday.
Yeah, I mean, a lot went wrong this week. I mean, we had, the war was bad enough, but markets seemed to be handling that okay. But we also had a jobs number that was terrible. The United States lost 92,000 jobs in February. We have the AI fears are still there, and we have problems over in private credit that seem to be mounting. Funds having to put up gates to keep people from taking their money out. And you put that all together, and that's a lot of worries, especially for a market that was really dependent on AI and the idea of very strong economic growth to keep it going.
Any good news here? Silver lining?
When I look at the market, it's not down as much as it could be. It's closed the week right around where there's been support. It's been kind of range bound for the entire year, and it's still at the bottom of this support level. And so I'm hoping that it can actually mount a rally off of that level. But if it does break, we probably have some problems.
I mean, it's true. The S&P's had a great run. It was 5,000 2 years ago. It touched 7,000 in January. So we're not in bad shape. One thing going on here, though, is the Fed isn't really in a position to ride to the rescue. Yeah,
I mean, you would think with a weak jobs number, everyone would be, oh, the Fed's going to cut. This is great. But when you have the oil prices rising the way they are and creating the risk of inflation, and there were already some concerns bubbling about inflation before this, you think, okay, what's the Fed going to do? It can cut rates to try to get the economy going to support jobs, but is that just going to spur more inflation? Or it could do nothing, and that just lets the economy weaken. So there's really no good answer, and I think we'll see that when the Fed meets later this month.
Alrighty. Jack, you wrote the cover story for Barron's this week on the Iran situation. Given the news that we just heard from Ben, what is the investor playbook right now?
I think there's a strong case for doing nothing at the moment, assuming you don't own garbage. If you own garbage, do something. But assuming you're a typical 60-40 investor and you have broad, cheap exposure to stocks, including U.S. stocks, to Ben's point, the stock market did not react as much as the oil market did. And a lot of people wonder why. Why isn't the stock market crashing based on what I'm seeing on TV? Sometimes there are world events that are, people call it resilience on Wall Street. It sounds a little too heroic. Sometimes there are world events that are deadly serious, but they don't much affect future demand for Oreo cookies and iPhones and NVIDIA chips. That's just the reality of it. So, and also the U.S. has been a net energy exporter since 2001. Not the case in Europe, certainly not the case in Japan, and you saw bigger moves overseas. Barclays looked at what happens to U.S. stocks typically after these big geopolitical risk flare-ups, and they found that after the biggest ones on average, the market went up 12%. You can stay put.
Over what period?
Over the following year.
Okay.
The Wall Street banks have been trying to slice and dice and say what tends to do best. Be careful there. They find value stocks tend to do well. The problem with that is we've already seen these violent rotations underneath the surface of the market since the beginning of the year, in fact, late last year. So you're buying into, let's say, a cheap value ETF right now. You might be paying 19 times earnings. It's not quite a value price.
Any tactical moves at all you would suggest?
I would say overseas sold off more. If you've been someone who's been neglected, overseas have been outperforming since the beginning of last year. If you've neglected having some exposure there, you can look at something like the VXUS. And I might be the only one, but as I've said before, I am a dividend fetishist. Polite Financial Society does not approve of my kink, but I think dividends are a good idea. Something like the SCHD gives you a cushion of income coming in, and it's cheap at about 15, 16 times earnings.
What do you wear to a late night dividend fetish party?
We'll talk after this. I'll give you some tips.
By the way, that ETF owns Lockheed Martin and ConocoPhillips, so it is kind of an Iran play. Elizabeth, one of the questions hanging over the market right now is how high will the price of oil go? This past week was the biggest move we have literally ever seen in oil. What are you watching?
That's right, Jack. We've seen several Gulf producers cut their volume because it's just too difficult, including Kuwait, because it's too risky to get oil through the Strait of Hormuz right now. And we're starting to see that reduced volume reflected in oil prices, like you said. According to data from AAA and OPIS, which is the Dow Jones Energy Service, prices have shot up almost 35 cents since the start of the conflict, and with crude futures soaring, we're likely to see more pain at the pump.
There's a formula for this. Give us the math.
There is. The math is for every $10 increase in the price of a barrel of oil, we're looking at a 35 gas goes up by about a quarter, about 25 cents. And, analysts say that oil prices really start to crimp economic growth around $125 a barrel. And when we get to $150 a barrel, we're looking at a likely recession.
Oh, thanks for that great news.
Yeah, I know. Well, Qatar's energy minister has said that with, volume way down, we actually could get to 150.
All right, and oil is a crucial input. This economy still runs on oil, despite the solar panels. So if that should happen, it can get ugly.
And it's also interesting with LNG and how that is a problem too, because so much of Europe is powered by that, and that's not going through the Strait. That's even a bigger issue perhaps than oil.
We are exporting some, but not enough to keep the lights on in Europe, I don't think. All righty, thanks, guys.